Coming up in the next session, a focus on India. Smita Aggarwal, Global Investments Advisor at Flourish Ventures, will moderate a fireside chat with Sanjay Nayar, Partner and Chief Executive Officer of KKR India. This session will look to understand more about the local capital markets and the efforts made to improve them. We'll now go to Smita and Sanjay for this case study on India.
Good morning, good afternoon. It's a pleasure to be here, part of the Singapore FinTech Festival. I'm pleased to welcome Sanjay Nayar, CEO of KKR India. Sanjay has been a veteran banker with a long and illustrious career at the Citigroup. He is now at KKR India, leading private equity alternative investment platform across a range of asset classes. He's also an early stage backer of startups through his family office and an important observer of capital markets in India. Sanjay has served in several important committees with the Government of India and Reserve Bank of India. 2020, as we all know, has been a year of a global crisis of an unprecedented scale. It has also been a year where a lot of well-entrenched notions have been challenged, and we have seen new behaviors, new business models, and new themes emerge. Over the next 30 minutes or so, we will delve into India specifically, covering both equity and debt capital markets and what the future looks like. Welcome, Sanjay.
Thank you.
After the crash in March, equity markets in India have rebounded very well. The stimulus measures have resulted in low levels of yields and reduction in cost of debt. There has been a flurry of first-time issuers in the corporate bond market. We have seen GST collections pick up for consecutive months. Sanjay, what has 2020 been like for India's macro picture? And do you believe the worst is behind us?
Firstly, I think, thank you for the opportunity to talk to all of you. Yes, I think the worst is behind us, although I don't think one can necessarily predict what the trends and the trend line will be like for at least, I would say, 2 more quarters. What's absolutely been fortunate for India has been the macroeconomic stability. And therefore, in a way, that preserves the growth opportunity that is there. And for that, I think a lot of credit goes to the government for being extremely calibrated in its fiscal stimulus and extremely targeted towards the audience to whom they're giving the fiscal stimulus. And that has, in a way, preserved the macroeconomic stability and not blown up the fiscal deficit, but at the same time, given the stimulus to the people that are probably the most affected. So that's number 1. Number 2, I think what's critical is that, you know, the whole idea of digitization in India has something that the government has promoted for a very long time. And that has helped a lot as well, because you're seeing a massive change in consumption patterns. And I think they're benefiting massively because of the digitization of the economy. You put all that together, and then you see which are the countries where there is long-term growth and macroeconomic stability. Even if you can't predict what the growth rate will be for the next 2 quarters, I think India makes obviously a great destination for both foreign capital and local capital. We'll come to that later. Local capital is obviously much lesser right now, and we'll talk about that. But yes, from a foreign capital investor's point of view, both debt and equity, this market looks extremely interesting, and how it has tackled the pandemic. Again, not declaring victory as yet, but clearly the trend is positive.
Sanjay, you made an important point around targeted fiscal stimulus to the people who were most vulnerable and who needed it the most. In fact, across the world, India has actually drawn praise for its ability to do direct money transfers into the hands of the beneficiaries at the last mile, whereas we've seen many Western economies struggle with that entire effort of reaching out government stimulus to the last mile. India also has a healthy savings rate of nearly 30% of GDP, and this has helped many weather the shock of the pandemic and survive through the drastic drop in income. What's your sense of how do you see this evolve into the impact, the savings potential, and how does that translate into stimulus for growth going forward?
That's a great question. Yes, savings rates right now may not be as high as they were in the past, but for obvious reasons. I would say they will probably come back once we have seen the backside of inflation and we see the hopefully increased employment and the effect of the subsidies and the targeted stimulus flowing down to the audience. The most positive impact is in the rural economy right now, and therefore that consumption pickup is evident across all sectors. Second, the private sector consumption in the urban areas is booming and is booming mostly through e-commerce. But I think once the structural consumption is back, driven by employment and confidence of the pandemic behind us, I think that consumption is bound to come back with a vengeance. And third, the biggest driver, I think, will be the infrastructure spending that is going on, driven mostly by the government. And that has continued despite the pandemic, during the pandemic, and I can just see it in Bombay, the amount of construction that is going on. These are going to be the big drivers for the future. Now, the local savings rates will need to pick up a lot more. And because the government of India runs a pretty large fiscal deficit, what happens is that through various mechanisms, you end up preempting a lot of high quality, local, long duration savings to bridge the fiscal deficit through enormous amount of bond issuances and all kinds of mechanisms where insurance and pension funds in India have to invest in the government bonds. But look, that's important for us because that again gives you macroeconomic stability, and the government is not borrowing in dollars, but it's borrowing in rupees. But what it does, Smita, is that local savings don't find its way into the real sector in India, and therefore there is this whole opportunity for foreign capital. Now, as an investor, yes, that's good. We are going to have a lot of opportunities. I know including your own business will see a lot of venture capital opportunities. But long run, the country has to develop much deeper local pools of capital to fund its growth. So I think we're in a very dynamic situation right now. We're extremely lucky that foreign capital is flowing in and bridging that gap in the country today between investment and the requirement of capital. But ultimately, it'll have to be local pools of capital that have to dominate the requirement of capital for growth in this country. And there are some early signs, and I'm happy to talk about that. If you look at the issuances of debt and equity and the growth in mutual funds, there is some pickup, definitely.
Yeah, absolutely. I think what you're saying is a very important point, that while we have seen more capital being raised through the equity markets this year than before, we have seen the debt markets being more stable. But we also see that the credit to GDP ratio for India is relatively low compared to other emerging economies. And so are we saying that the savings, as you just mentioned, is not being used fruitfully and productively for the growth? So talk about how that can translate into, increasing the credit outflow, increasing the investment opportunities. What needs to be done? What are the bottlenecks? What has been done, and what more can be done to unlock that potential?
So let's take it one at a time. The credit to GDP ratio is low for two reasons. One, there isn't enough demand for credit. And secondly, the avenues for giving credit are quite limited. The demand for credit is low because, as I said earlier, besides the government sector, the private sector is still to pick up investment. That is not yet picking up, and I'm sure it will after the pandemic, and as the private sector gets more hopeful about investing and sees demand coming back. So that credit GDP ratio will improve when there is investment by the private sector. Then you come to the point, where is the capital going to come from? If you're going to depend only upon traditional banks, I think it's not going to fulfill the vision the Prime Minister has, the government has, of having a 5 trillion economy by 2024-25. And therefore, you will need alternate mechanisms. You will need the non-bank finance companies. You will need a lot of fintech revolution, because you have to get, India is a very diverse country, right? Not only geographically, but also from a consumption point of view of credit. So you have to go to all these new segments And I think that'll get facilitated by new banks, new banking models, new credit models, and then obviously a sliver of fintech on top of that. I would say that is the two most important things to watch for right now. Uh, I'm sure we can talk about a little bit about the new potential discussion paper that's out there in the financial sector right now, issued by the Reserve Bank of India's internal working group. But people are thinking extremely hard. How do you get more local credit into the economy in a more diverse way and not just traditional banking? So I think that's something that you have to really watch out for. The one thing that is, sorry, go ahead, please.
No, so Sanjay, on that point of getting credit out, so we have this paradoxical situation where you have over reliance on the banking sector for corporate debt, and the banks are obviously have a huge challenge with the NPA issues that they have been struggling with. On the other hand, there is this huge unserved demand for credit for SMEs and individuals and household debt. All of that is completely unserved. And there are players like the NBFCs who are bridging that gap, but obviously that's not enough. So in that context, now kind of lay out, what is the new working group of RBI? How is, what are the ideas around there that could help change the situation? How else could the personal savings that are locked up in pension funds and insurance companies find their way?
Smita, the most important thing you need in any emerging economy, and if you look around even the region, you look at Malaysia and you look at some of the other markets, you need a robust corporate bond market. That's number one. Today, the bond market in India, I would say nearly 95% is dominated by public sector, the government, and the parastatals, okay? And then within that context, it's really a AA plus market. There is no credit available through the corporate bond route for AA plus and lower. I think as much as 90% of the issuances today and the holding of bonds is AA plus, which includes obviously the government. The first and the foremost criteria to get a bond market going is you have a bankruptcy code. And I think we have that. That has been an incredible achievement by this government. They came in, they heard about it from a lot of experts, and they implemented it. Of course, it's taken a bit of setback thanks to COVID, but it's a system that works. So you have a corporate bond market, which will flourish once the bankruptcy code is well established, which I think India has now. So that's number one. Number two, as I said, you've got to have an ability of having diverse set of issuers, not just AA plus. You need lower and lower level of grades of risk rating. There's a risk reward and there's a price for every credit. So unless you're able to create a bond market that has a price and has the right risk rating for every issuer, that's when the corporate bond market will become much more diverse and wider. Today it is very narrow. It's pretty deep, but it's very narrow with just AA plus and parastatals and government. So you need to widen it and you need to deepen it. Like our equity markets. Our equity markets have done extremely well, both in terms of width and depth. But the corporate bond market becomes extremely critical. And the last point is that, look, traditionally, credit doesn't grow just by piling on bigger balance sheets in banks or bigger balance sheets with NBFCs. And therefore you put in more equity, then they leverage it more, and then they use the books. The way other economies, the more developed ones, have done is that when you have a robust bond market, you have all kinds of pools of loans that you can bundle and sell. So you need to create a very robust secondary market once you have a good primary bond market. And that's when you bundle loans, you bundle mortgages, and you bundle all kinds of risk, and you sell it. And the final point is, who do you sell it to? And that's where you need the local insurance, the local pension, the local high net worth capital to be available. So that facilitation process in India, I think, will happen over the next 1 year. I think the Ministry of Finance, the securities regulator, the insurance regulator, the pension regulator, and of course the central bank are all seized of this, because the only way you make this whole thing well-oiled and get a high velocity is you got to book these loans and you got to sell them. Otherwise, you're going to have a banking sector that will just need more and more equity and larger balance sheet. And to your last point, this pandemic is going to make a lot of people think as to how much credit growth you want on your balance sheet, right? Because we've had a couple of moratoriums announced here. Now they're getting lifted. So really what the quality of the credit is going to show up in the next 2 quarters. So I think the only way forward for us to achieve the 5 trillion vision, you need a lot more credit. You need alternate forms of credit conduit. You just can't do on banking and NBFC balance sheets. And finally, you need new kinds of banks, which probably will come from large NBFCs converting to banks. And then, of course, in future, hopefully the neobanks and the challenger banks, which I think is a bit far away. But that's really the vision that I see being laid out for the next, I would say, 1 year. Definitely this year, a lot's going to happen. And then in the next 3 years.
Right, very well said. And I think one of the sectors in, which is going to be a growth engine for the economy is really the SME sector, which is hugely credit starved. And one of the big issues with that has been, the informality of that sector, the invisibility of that of that customer segment. It's very difficult to reach it's such a dispersed customer segment. Do you see digitization and the entire fintech revolution that you alluded to at the beginning, changing some of that? What are the opportunities do you see for SMEs and to be able to drive that growth engine?
Not an expert in that area, Smita, but I would say that India has taken the lead in terms of digitization of the economy, driven by the vision of the Prime Minister. You see the creation of the UPI. It's amazing. It's the whole UPI makes peer-to-peer payments and lending so much easier. API banking is the way to go. You're going to see a lot of leverage of internet and mobility. You're going to see AI and you're going to see conversational banking. All of this is going to be the differentiated fintech lending models that will try and help the SMEs who do not necessarily have all the formal documents or ability to get formal credit from banks. So informal credit will be available. And I think the neobanks and the neo NBFCs and the fintech lenders will use all these new tools that are emerging in the world to be able to suss out the real credit issues in SMEs who cannot get formal credit. Put them into excellent risk algorithms. And I think Singapore, in fact, is a leader in what's going on in that area, and then try to give them credit. But ultimately, again, it comes down to those balance sheets who do this lending and again, sell it down to different pools of capital. That's very, very critical. So I'm not an expert in fintech, but I think there is a future out there. And we're seeing a few examples start up in India, but we have a long way to go on that.
And, coming back to this whole, deepening of the credit pools, opening up more avenues and different types of instruments from a policy intervention standpoint. You mentioned all the regulators are seized of the issue. Are there specific asks or expectations that you have of actions and interventions that could catalyze this whole effort, given that in this current environment, even the government and policymakers are more amenable to kind of take measures that could actually revive growth, unlock potential? So what would be those specific expectations you have?
I won't get into exact specifics, but I've been part of many committees on the development of the bond markets. So at a very macro level, the fiscal deficit basically has to come under control, which is not going to happen for another year or so, and that's understandable. That's the only way the government gets out of the way and the private sector comes in. Right now, the private sector does get squeezed out a little bit. So that's a very macro statement, and I think that will expedite the reforms that one is looking for. Without getting into specifics, you need to encourage the issuers and make it easy for the issuers of debt paper to get their paper listed and intermediated. That's number one. A lot of that sits in the court of our securities regulator. They're very seized of it. Obviously, they have to keep an extremely watchful eye on the quality of paper that is coming out. It's just not about being easy, but you also got to keep a check on the quality. On the supply side of capital, as I mentioned, pension, insurance, banking regulators are getting together, and there's a lot of discussion going on how to change certain amount of thresholds that limit them from having exposure beyond a point into these private sector bonds. There are many limitations today in insurance and pension where you cannot have more than X amount in AA, X amount in AA minus. A lot of that has to be opened up so that the flood of capital can start. I would say the last thing is the governance on the supply side. Insurance companies, pension funds in India have a lot of capital and growing by the day. How are they managed? Who are the investment managers? How they take decisions? They will have to get a lot more, tiered up a little bit, have to get experts. Because again, just like the demand side, you can't have the supply side not knowing what they're doing and what they're buying. So it is a longish process, Smita, but it has started. And I would say that the pandemic is going to be a great opportunity for the Indian regulators and the Ministry of Finance to really expedite these reforms. Again, I want to repeat, unless you have a much more diverse bond market in India and a deeper market, very tough to achieve the credit ambitions you have to achieve the GDP growth.
And how do you see all of these reforms and changes in the local market impacting the foreign inflow of capital? What are the linkages? If there's a deeper local market, does that also attract and make it more attractive for foreign investors?
Absolutely. I mean, today, as an investor, you invest in India. I suppose one of your criteria is how do I exit my investment, right?
Exactly.
And now we're lucky that the IPO markets are back, and we've had IPO volumes year to date nearly as much as last year, despite the pandemic. But the fact of the matter is that foreign capital will be even more willing to come in when you have deeper financial markets, both equity and debt. I think the equity markets have proven that they can absorb a lot more IPOs. They have proven that this year, in fact, there are more secondary sales than primary raising of capital. But the bond market's also very critical because, as you are an investor as well, you do need avenues to leverage. You do need avenues for your companies to borrow, and it just cannot, again, be the banks. So deeper debt markets and deeper equity markets, I think, will encourage much more foreign capital to come in. Foreign capital, of course, is, most welcome today because you need the foreign capital. But I'm saying in the very near future, deeper markets locally are very, very critical if you want to get more foreign capital. Foreign capital can come in and always can't say, oh, I'm going to do a strategic exit. It doesn't work like that. India is an economy run by entrepreneurs, run by families, run by founders. And you want to be able to back these companies to make them bigger, to make them better. But ultimately, you do want an ability where you can finance them, where you can finance out, finance in with local capital, not always international capital. So I think that it's a virtuous cycle. Deeper markets, more foreign capital, more forms of capital available at different risk on the risk spectrum. I think that's the way to go. I mean, I'm a big votary of this. I've just been only pushing this for God knows how long. Whenever I get a chance, you've got to deepen the debt markets, and also the equity markets are becoming a lot better. And I think you've got to really appreciate the kind of work that our securities regulator has done here to be extremely watchful. We had very few, if no accidents, and that improves the confidence of the investors in general and, of course, of the regulators.
Absolutely. In fact, one of the trends in the 2020 numbers, if you see on the debt market side, there has been a higher issuance of longer duration. So what do you read of that? Is there a higher risk appetite that is getting created? Double click on that for us.
I think people just think rates are going to come down, so they want to lock in rates. The longer duration, the better. Yeah, but most of these bonds, long duration bonds, are coming from the banks, coming from parastatals, coming from public sector. So I don't think you can read much into it. except that there is a very robust market on the 10-year plus duration, thanks to where people think the rates are going, including foreign capital. Remember, foreign capital is allowed in the debt markets. So if somebody can lock in, 7.15% even in rupees for 10 years, why not? So that's really what's going on. But again, that's all the AA plus market, please. So it's not an indicator of what the true cost of capital will be when the lower credits come in. So I think that is important. You have to make credit available to a whole lot of companies that are not AA plus and a whole lot of SMEs. Otherwise, you're going to be highly constrained for growth.
And also, when you talked about the diversification of the investor base, on the equity side in India, one of the big challenges so far has been the retail participation. And in this year, despite the COVID and pandemic, you've actually seen the retail participation, jump significantly. Obviously, people have had more liquidity, probably, so is that driven by better access, better technology, or is it driven by better, risk appetite? What do you think is going on, and where do you think this is going to go?
In fact, what the equity markets are achieving is exactly what the debt markets need to do. So on the equity markets, you have phenomenal platforms of settlement, which, by the way, even on the debt side, the platforms created by the regulators are excellent, the settlement platforms. Remember, the old days, we used to have paper shares, okay? That's all history. So the platforms created in the equity market are phenomenal. Secondly, the mutual funds have done a fantastic job in marketing the product, and the regulator has been extremely watchful also in terms of the intermediation fees and making sure that the investors are getting a fair deal. So that's the second thing. The third aspect is that more and more families, more and more individuals are coming into the systematic investment plans, the monthly investment plans. And that is a great sign. It's not about just someone putting a large check into an equity fund. It's systematic investing has really taken off in this country. And that's why the mutual fund growth has been phenomenal. And again, that's because of the confidence that they have in the economy, the way they look at inflation, the way they look at risk reward. Remember, Indians are that way pretty smart investors. And I think once you make the platform available to them, the mutual fund product easily available to them, getting in and getting out easy for them, a cost of intermediation to be minimal, which the regulators have achieved. I think that's what is promoting the equity market right now. And then high quality IPOs. And, look at the IPO index for this year, BSE IPO index. It's been the best performing IPO index, YTD, Absolutely. In 2020. And look at just India's stock market performance compared to so many countries. So it goes to show that it takes a lot of things to make a robust market. And I just think same thing should happen on the debt side. And I think then we are off to the races.
So as you project, we've got a last 1 minute for this session. And as you project into 2021, what is your outlook? What would you be excited about?
I would just watch first 2 quarters of the calendar year to just see what comes out of the banking credit as these moratoriums lift. And as the second, I would watch out for consumption. Is there a structural uptick or was it a temporary uptick? And third, I would watch for the development of the financial markets, the deepening of the financial markets, and the new regulations coming around the new banks and the NBFCs. 3 big things to watch for. First 6 months will be extremely critical for that.
And would you still go back to your initial statement that India continues to be a very attractive destination for investors?
Absolutely. I'm not necessarily talking of the valuations where they are today, but long-term, extremely attractive. And I come back to the issue of macroeconomic stability and just the compelling consumption demographics.
Thank you so much, Sanjay. This has been such a pleasure getting these wonderful insights and overview.
Thank you, Smita and Sanjay, for sharing your thoughts with us and helping to uncover insights into India's capital markets.